Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up, we'll talk craft beer and its spot in grocery stores compared with macro beer. We'll also talk about Walmart as they officially dropped Lyft and Uber, and we lead our show with Fossil reporting their earnings. Later on, we'll have an interview with Stephen Wakeling of Phobio, who will be talking about a new way to communicate in the retail workplace. But again, we lead with Fossil today as they reported on Tuesday of this week, and revenue falls yet again amid strengths in connected watches. Now, Fossil is, of course, known for their men's and women's fashion accessories, mainly watches. They're also known for a pretty poor investor relations page. I think if you're trying to do any research on them, their product portfolio has gotten a bit more diverse over time as the company does market sunglasses, belts, hats, handbags, and even some outerwear. They are viewed as higher end, but not super or ultra premium as in the case of other designer brands, but they have partnered with brands in the past such as Michael Kors. Last time we discussed Fossil on the podcast, we struck of their restructuring and store consolidation. This company, Leighton, with a global presence, the results weren't great, but the shares, if you looked at them, you wouldn't know it.
One of the things that struck us as odd was the fact that the company's stock was up around 21% on Tuesday through Wednesday afternoon's trading, and you see that the company is yet again posting a net loss for their quarter. The company, like Trent had alluded to, is made up of several product categories: watches, leathers, jewelry, and other. Watches currently make up around 78% of sales, while leathers make up 12%, followed by jewelry and their other category. Most of their sales are actually made up in their Americas region, where they bring in around 45% of sales. But we'll talk about this net loss and what it means for the shareholders. This time it was a net loss of $48.3 million or 99 cents per share. Investors were pleased to know that it wasn't as bad as the analyst consensus out there. They had expected an earnings per share loss of around 6 cents less. The 99 cents per share loss for the company did include 35 cents of one-time restructuring charges, and Trent will actually be looking to see more of those one-time charges as the company looks to restructure and strategically cut costs in the future. Revenue also fell year over year by around 2.2%, or roughly $30 million to $539 million. The company expects sales to continue to slip versus 2017's numbers. So not a great outlook for the company, but they are looking to stabilize. They expect full fiscal 2018 revenue to fall between 5 and 12%. So pretty wide gap there if you're an analyst trying to forecast throughout the next few quarters. Retail comps were up 5% in this first quarter. These comps are comprised of physical stores and their growing direct-to-consumer business, not the third-party retailers or e-commerce players that they source their products out to. The Americas region was up, again, their biggest region, was up a boisterous 12% with the wearable accessories. They have closed 81 stores since the first quarter of 2017. They now operate 512 stores. And this is something we had talked about the last time we covered an earnings report for Fossil, was the fact that they're trying to hone in exactly what their consumers want in terms of the brick and mortar experience. And we'll get into some of those initiatives a little later on when we're talking about the call insights. Sales for conventional watches fell in every operating territory. And these conventional watches are not made up of those new smartwatches you see and all of the brands trying to attach themselves to. Some ground was made up thanks to currency translation. You see a lot of positive impact for that for the company, which really did help their bottom line significantly this quarter. And despite this poor sales showing, management is glad that sales in general were above expectations. Again, aside from all the positive currency impacts, they said that they were actually positively surprised in a number of ways this quarter. With any type of manufacturing environment, the idea of continuous improvement is always a big one. Whether you're manufacturing airplanes or cars, this type of idea, this idea that everyone is on board for quality, is important, and it's certainly important for this watchmaker. A company can live or die on the tone of the culture as it relates to constant improvement and the evolution of its products. With Fossil, they feel this is exactly where they still hold at least some competitive advantage out there versus their competitors. They spoke of design, innovation, and distribution among other areas that they feel they can really one-up their competitors in 2018. In particular, innovation with new entire categories, new designs within existing categories is something we feel they should be devoting a large amount of resources to. And this is something the company reiterated to investors. They are definitely being huge into R&D and really trying to invest into connected watches. And while connected fitness hardware like Fitbits didn't prove to eat too much into the watch market share, smartwatches are certainly an emerging factor and have been over the last 2 to 3 years. Obviously, the Apple Watch has been big out there. So while Fossil this quarter talked about being more operationally efficient, they never failed to ignore how their sales in the smartwatch category actually doubled this quarter.
This helps sales in every region, the smartwatch category doubling for them, but it seemed to help their Americas division the most. With all territories, smartwatch sales grew 97% before accounting for currency fluctuation. Now, despite honing in on innovations and some good old research and development, they squeezed out some marginal margin improvement in terms of their cost of goods sold. Gross margin for the first quarter was 70 basis points higher than this time last year at 50.5%. They haven't taken too much of a hit on pricing when distributing to third-party e-commerce sites, and based on management's relative enthusiasm and the laws of scale, we can see that smartwatch designs improve at a faster pace than their older, more legacy product divisions. So everything we heard on the call was fairly similar to previous calls we've covered or listened to, even when not choosing to discuss it on the podcast. Their CEO highlighted some basic fundamentals that have been part of their vision to become a more modern company. They want to adjust quicker to the needs of its customer base, and I think we've heard that on earnings calls probably throughout the last 3 years. The underlying goal, though, is to bring about profitability. That's the key, especially for a business that struggled off and on over that time period like Fossil has, while also pursuing the right avenues that will propel them into sustainable sales growth. Now, beyond product differentiation through design innovation, they know that marketing to younger generations will require more digital ad campaigns. And for a company like Fossil, despite the name, this may mean getting a hold of expensive but worthy social influencers. They said that current initiatives had already yielded double-digit gains in terms of followers and impressions, and as we know, these followers are far more valuable, especially if they are micro influencers in emerging areas. They feel like when these elements all combine into a transformative long-term strategy, they'll be able to capture more wearable market share and even be potentially an eventual market leader for smartwatches and conventional watches. Now, that's their feeling. We have our doubts about it, particularly when you see the overall momentum towards smartwatches beginning to slow, even though growth of that category is taking place. It's slightly less growth than what we were seeing 18 months ago. Fossil Management noted in-house research that indicates mid-tier smartwatch growth at 5 to 7% per year for the next 3 to 5 years. It's a decent growth pattern, but again, not quite what we had been seeing over the last 18 months. And what's the mid-tier connected watch, you might ask? They deem it, their research does, to be one that has an MSRP under $1,000. What is interesting here is that they mention modest wholesale growth in normally priced watches, but better than expected growth in off-price selections outside of these expensive smartwatches. So again, perhaps watching the off-price in the future, they no doubt are seeing the same retail trends we are as it pertains to off-price. And in order to do this, they're going to have to make it easier for new and existing customers to get their accessories with as little friction as possible. Naturally, this means connecting e-commerce segments to brick and mortar. The so-called expansion of buy online, pick up in store will pick up, but we don't see a set-in-stone plan right now for 100% retail store adoption of the omni-channel functionality, or at least if they have one, they have not mentioned it on an earnings call, and they haven't mentioned it in an analyst Q&A. They do want to be able, though, to ship from store, which could, in theory, clear out some of the slower-moving units that might be backstocked in a particular store. Maybe a unit doesn't do well in a certain area. Rather than having to reallocate that resource to the warehouse, the store itself should be able to ship that out, much like, say, a JCPenney is putting into place now. Now, Leighton, I don't own a smartwatch. I think it's slightly redundant for me to own something that my cell phone does a lot of, and I honestly don't like things on my arms too much. I haven't seen you wearing a smartwatch. Is this something you have at home?
No, absolutely not. And, here we're trying to infuse a little bit of personality into the podcast, but as our listeners can probably tell, it's a bit rough. We honestly had talked about this company because this is a company we can't personally relate to, and that Fossil has been around for quite some time. And yes, we have covered it on previous podcasts, but this is a company that we honestly rarely buy from. They do sell some accessories that we see in conventional stores like belt buckles and things of that nature. But in terms of wearing a watch, no, I do not. Conventional watches are just something I've never been into. I know it's more of a fashion statement. And then as it pertains to smartwatches, I can applaud their recent success with doubling down in the first quarter in terms of smartwatch sales. But overall, like you said, Trent, I have a smartphone. I know what time it is. I know who's calling me. And it really offers nothing more in terms of convenience for me. Now, I understand that a lot of people do go to the gym and use it sort of as a Fitbit to track their heart rate and things of that nature and really stay connected if their phone is in a nearby locker. But overall, it's not something that I see buying over the next few years. And again, you're talking about a mid-tier price point under $1,000. I'm sorry, but I barely have $300 to spend on my smartphone alone. So as you can see, a lot of mixed results here for the company, but a lot of traders do like it. And as for the traders of those shares, they were pleased to see that 21% jump on Wednesday. Shares of Fossil, ticker FOSL, are now trading around $18.90 a share, way up from the 16-year lows of around $5 just in November of last year. So the company has done very well in a short amount of time, up 37% if you look over the last 52 weeks. Walmart has been all over the news. We have heard about them overpaying potentially for Flipkart over there in India, but it was their termination of the Uber and Lyft pilot delivery programs that hit our radar this week. Earlier this week, Walmart announced the formal termination of both programs. A lot of people saying this was an abrupt end and a lot of lack of communication between all parties involved. Walmart is known for not necessarily getting fully behind the companies it partners with, at least in the past. Failure to effectively communicate goals has made it difficult to create real progress for both the startup companies involved that they've bought and the companies that they do business with independently. So independent of buying a company wholly, they really have had some problems trying to integrate through different partnerships over the last few years, something that Walmart has been criticized at length about, just paying for something and not really tending to it thereafter. 2 years ago on this very podcast, we spoke of Walmart's partnership with Uber and Lyft. Uber in Arizona, Lyft in Colorado, Denver, Colorado to be exact. This was when last mile delivery was becoming a thing. And I say last mile delivery because now everyone is saying last mile delivery like it is a process that every retailer should be attending to. Walmart felt the need to deliver on its process to compete for convenience against others, namely Amazon, who started same-day delivery in a number of markets at that time. According to CNBC, Walmart felt like it was beginning to be too much of an ask for Uber drivers to have two separate missions. One, to deliver people, obviously from point A to point B, which is what they've been known for. But second, to deliver Walmart packages to homes. The different dynamic reportedly brought about some problems, which we can really only speculate here that it potentially had to do with missing delivery windows. In our view, there is little that could be working against Uber or Lyft in this particular partnership with Walmart. There's really only a basic benchmark that you can rate how well this partnership is doing. You have adequate last mile delivery, and you define it by saying simply, are the packages getting delivered? Are they in good shape? So are the drivers destroying the packages or stealing the merchandise? And were they delivered in the promised time frame? If the answer was yes to all of these questions, it's hard to imagine a world where Walmart decides to abruptly end the program if it's working 100% of the time. So I think this was a big indication for us, Trent, that something was just not working out between these three companies.
And another big indication as far as this partnership maybe not working was our recent April story about Postmates being an East Coast partner for Walmart. Those Postmates plans were much larger from the get-go starting with Charlotte, North Carolina, and quickly spreading to other unnamed markets within months. At least those were the plans. Walmart has not been shy about pitting merchandise suppliers against one another in negotiations, and this is really no different in that Walmart's letting these courier service providers know, look, we're going to try everything until we find what works and who works with it best. And while this strategy can help to scare companies like Postmates and Lyft to be on their best behavior while in a partnership, this does enable Walmart competitors to forge better relationships with these companies by promising longer-term deals. It gives their drivers some stability and the underlying business some steady income. And we should also keep in mind that it's not really a business running the individual employees here in the gig economy. Most of these employees are 1099 employees, and so as long as they don't get paid, they really don't care or don't have a ton of reason to care about long-term partnerships between their parent company and Walmart. So it's something where they may not have a whole lot of pride towards their particular company, and that's another hurdle that companies in that gig economy will need to cross. Still, though, Walmart does have a massive need to fill. As Leighton mentioned with the last mile services, just about every retailer feels as though they need something for a last mile service, especially general merchandise and food retailers, and Walmart fits in both of those categories. While most of Walmart's partnerships focus strictly on grocery delivery to those within city limits, they want to expand same-day delivery to 40% of U.S. households overall, with delivery hitting nearly 800 total stores in the next 8 or so months. The company rightfully sees it as an imperative to partner with anyone and everyone, especially if that partner has significant penetration in those particular markets that they want to roll this program out to. Last month's rumors did tell a different story about Walmart's near-term strategy. It was one that comprised some sense of loyalty to their current delivery partners, wherein they had no concrete plans to reach out to any new service after the Postmates announcement. Fast forward to now, and we see that may be indeed the case for Walmart. Instead of growing certain partnerships, they're legitimately consolidating, and in doing so, slowly growing in established same-day delivery markets. Uber was apparently under the impression that the relationship was actually going better than Walmart perceived it was. According to an unnamed source provided by CNBC, there was a stated lack of communication between the two companies, and it's unclear whether or not Uber's constant negative headlines that we've seen over the last year to 18 months got in the way of any future plans. But it wouldn't surprise us, as there are still some lingering questions about their autonomous car program and their true profitability prospects. Uber's delivery operations will officially end on June 30th, and this marks the end of what Uber described as their biggest rush service. This is not only ending for Walmart, but it's going to end for their entire rush program, which delivers not only groceries but general merchandise on behalf of retailers. So maybe some market share opening up for other companies. We mentioned, of course, Postmates getting into this category, but of course you can't go a last mile story without talking about Instacart or Shipt. As for Lyft's Denver pilot program, there appears to be a transitional partnership in place very soon. This isn't a hard end like what we'll see with Uber. Lyft's executives have not relayed formal comment to the press about the ending of the partnership, but reading about the partnership from Lyft's website before this announcement, we saw that Lyft's policy allowed for their drivers to turn down the automated Walmart delivery requests. We also saw that the company described the Walmart partnership to their driver as a very small test, and I put that in quotes, as if to say, don't let it affect your normal workday, don't let it affect your normal Lyft operations. And having analyzed how Lyft perceived the initial coming together, we could maybe say that this was doomed from the start, in that perhaps they were not dedicating enough resources to Walmart, and Walmart was taking that proverbial back seat to the other riders in the Lyft program. They referred any problems that their drivers had with the Walmart delivery service to Walmart associates. So again, we're looking at a learning curve that might have been frustrating in that circumstance for all parties. And as for Walmart, if there is something clear about the direction of the company, Leighton, it's that groceries are still growing in terms of how much they make up of the total revenue pie.
This very grocery portion sits currently at Walmart for around 55 to 56% of revenue, which has been going up steadily over the last few years. You probably remember, Trent, growing up when we were 9, 10, 11 years old, and grocery would be a very small portion of the actual footprint in the Walmart store, but now it's just massive. And obviously, this is the one way Walmart can really connect with their customers and create that customer loyalty that everybody talks about in the retail industry. Groceries, since that is what everybody needs, having that be as convenient as possible is extremely important for Walmart. And this number, 56% of revenue, could theoretically be higher if they were able to extend out to their goal of 800 stores having this delivery option by the end of calendar year 2018. Another sure thing is that celebrations are probably happening at Postmates and Deliv headquarters. If you're working for them or you're an executive on the executive team there, you're probably stoked about them ending the Uber and Lyft partnerships, as this almost assuredly lets them know that they should be prepared to be partnered with the United States' largest retailer for a good while longer. I think this is something that a lot of people are going to be excited about. Anytime there's a big transition like this, it usually means Walmart has found one or two partners that it can rely on for the longer term. And while we've criticized Walmart in the past for their relationships with these strategic partners, I think it's going to be good news for a lot of people, especially for those people that like varying jobs that you don't have to clock in and out for, jobs that if you decide to work for a day, you can work for a day in a particular market. And if not, so be it. Everything's going to be okay. As far as Walmart and their stock, we should give an update there. Walmart, stock ticker WMT, sold off this week as investors shook their head in disapproval at the cost of the 77% stake in India's number one e-commerce player, Flipkart. And one of the reasons we didn't talk about this is if you listen to this podcast, you are probably inundated with the news from this acquisition, as we've been talking about it over the last 2 to 3 months, and other podcasters as well have been talking about this just in the general business realm, what this means for global e-commerce. The $16 billion deal brought shares down around 3.5% on Wednesday to around $82 a share. And let's not have too short-term memory loss and forget the all-time highs Walmart had not that long ago. $110 a share that the company saw in January of this year is sort of getting overshadowed by the lows they're seeing, or relative lows they're seeing now, because of Flipkart compounding a steady sell-off over the last few months. Shares have basically given back all of their gains from the previous 52 weeks. Amazon is officially worth 3 times now over Walmart in terms of market cap, $773 billion company versus Walmart's $252 billion market cap. And full disclosure, I am still a shareholder of Walmart. I was a shareholder of Amazon at one time. It should probably have been the other way around. I probably should have sold off Walmart and kept Amazon, but who am I?
One thing we've often covered on the podcast is retail employee dynamics, whether it's onboarding, employee training, or even loss prevention. Employees at the ground level are really what makes retail tick. And now more than ever, it's important to maintain a consistent line of communication with employees as the workforce continues to expect more and more organizational transparency. Joining us today to discuss retail workplace communication dynamics and where they might be headed in the future is Stephen Wakeling. He's the founder and CEO of Phobio. Now, Phobio provides a variety of services, but what we're most interested in as far as this podcast is their Rodeo platform that allows for structured communication to be facilitated within a retail workplace. Stephen, thanks so much for joining us today.
Thanks for having me.
Now, as we kind of look at communication within the retail workplace, where were we 20 years ago? Where were we 10 years ago? And where are we now, assuming not adoption quite yet of the Rodeo platform across the U.S.?
Retail communication, I think, has oftentimes been pretty stagnant. I think the expectation was that if you go back, 10 or 20 years, the expectation was that there were certain retail processes that had to take place. And kind of once you kind of learned those from a store manager or somebody in the locale, you're pretty much set. And as long as you were doing those processes, there wasn't a lot of communication that needed to come from the top down. It was just sell more stuff, be nicer to customers. And that was their kind of perennial messages. But I think, in the last couple of years, especially, our kind of home footprint is in this kind of wireless retail, which is changing all the time. If a one carrier comes up with some kind of crazy promotional activity, the other carriers immediately follow suit within 24 hours. And sometimes these kind of promotional activities can be pretty short run. Something might start on a Thursday and end on a Tuesday, or even shorter than that. And as the plans are changing, sometimes multiple times a year, and they'll roll out some kind of new data or insurance product that then is revised 2 or 3 times a year. And I think, there's the old kind of system under where the store manager will kind of tell you what's important and when you show up for work. It was kind of broken. So we saw this opportunity of kind of working with wireless retailers to help them with communication, specifically in-store communication. There's a couple of different kind of evolutions or even potentially revolutions happening. You see retail is just changing, and I'm sure you guys discuss that all the time on the podcast. There's greater pressure from online retailers. There's this need to kind of galvanize the best assets of kind of brick and mortar retailers, which are that they're down the street from you and they have people inside of that brick and mortar location that know stuff about the product and about the industry and can kind of have a conversation with you and assess what you may need. And also, there's kind of this retail kind of battle is happening. And then also like communication is changing for the most part, and certainly in wireless retail and many other kind of retail channels. The sales force is increasingly millennial. And there is this kind of communication gap between the kind of millennial and beyond generations and the kind of the preceding generations. They're much more comfortable with different access to information and a different way of communicating. And so we built Rodeo to help retailers kind of galvanize this mostly millennial sales force in a way that was most comfortable and kind of most productive for that millennial workforce.
I feel like a lot of our listener base probably had the same experience that I did. My first job in retail, you were signed on, as you mentioned, you met a few people and that was it. And any other learning about products pretty much came through osmosis. A lot of times you wouldn't even know any sales that were going on, anything, all of this stuff that you're talking about where promotional dynamics now happen so quickly. Is that, do you feel like, the main thing that all retailers, and not just retailers in the mobile space, but all retailers need to be better at, is making sure their community of employees is informed as to some of these quick sales and some of these sales that might pop up for just a time or two?
Yeah, and I think also just the need for retailers to continue to optimize and kind of better utilize these software tools and platforms to measure how they're performing, not only just like in the kind of the financial measurements, but to kind of build a more balanced scorecard around how well are they communicating internally? How knowledgeable is their sales staff in the retail locations? How effective are the retail salespeople at communicating? And I think these are things that can now be measured using things like Rodeo. We can kind of identify how quickly a top-down message can travel throughout the organization. We can use our AI tool, Rodeo Bot, to kind of measure the communication within a location and identify like how are they talking in a positive manner? How often is the average person interacting with their store management? Are there outliers, and like measures can you take to kind of boost the people who are lagging, and like how can you take the things that are working for like the performers and kind of spread those around the organization? And I think to be an optimized retailer in the future, these are all things that you want to be able to kind of put in your toolkit. And 5 or 10 years ago, you're right, it was just osmosis. It was just put the people in the store, hopefully you hire good ones, and maybe they'll figure it out, and hopefully they tell some other people that are around them what works and what doesn't. And I think today, you just have to be much more prescriptive about those things. And no, I think as a retailer, I would want to know, who in my organization has the knowledge about the products or the training that you can kind of incorporate, especially with Rodeo, learning management tools, and kind of see in the organization who has access to which modules, or if it's like an open kind of learning knowledge base kind of system, who's looking for what in that system, and like how can we kind of better produce content that is going to make our salespeople more valuable to us on the sales floor.
Now, when I played around with Rodeo and obviously visited the website, looked through the product, I think outside looking in, a lot of people are like, well, you can use an app like GroupMe that everyone else is using for this. But I think the difference here, and you kind of alluded to it, is that back-end data that you receive. And it seems like not only management, but even those that go above the store management level can see data in terms of who is interacting with the content. So can you kind of walk us through, if you're using it on the back end, if you're using it as a manager or someone that's trying to measure some of that data, how you would go about using Rodeo?
Yeah, so I think you're right. Like most retailers, I think the tail has wagged the dog a little bit. And so retail employees, especially millennial retail employees, have kind of adopted tools like WhatsApp and GroupMe almost universally. And I think they're great tools for chat, right? So there's a lot of noise going on there. They're talking about all kinds of things about what they did at the bar last night or who's going to the bar tonight, or all the various kind of things that the retail employees, and that's not to minimize the importance of that. Certainly to kind of a millennial workforce, these connections and this kind of constant feedback is really important. But this kind of signal to noise ratio becomes really important. The more noise, the kind of louder the signal needs to be. So in a group me, when a superior kind of puts in, say your sales leader for a region says, hey, there's a promotion starting today, and they drop that in group me, it's immediately off the top of the screen. And there is, all of this chatter about this thing, but you kind of lose the message. So one of the core things, and we found chat was really important and build a world-class kind of chat platform for Rodeo. And then on top of that, we layered a thing we call bulletins, which is an additional pane. It kind of the message, if you think of it, it's like a card that fills the screen of your smartphone, drops down on top of the chat interface, and then you can kind of swipe left or right, similar to like a Tinder swipe, to acknowledge that you've received that. So that's where some of this kind of top-down information, maybe there's a promotion running, a change to a plan, a new product, a new learning management tool, or some kind of administrative thing that everyone needs to know about, you can distribute that down the organization. So a vice president of sales at a corporate office may initiate the message and send it out to all of the district managers, who then can kind of retweet it down the chain to regional managers and then to store managers and eventually all the way to the sales floor if that's where the message needs to go. And on the way down, each manager can kind of contextualize it. The idea of selling 5,000 phones today may be kind of hard for a retail salesperson in Indianapolis to connect with. But if it's coming down saying, okay, for Indiana, this means 100 phones, and for this store, Adam, this means you need to sell 3 phones today. So you can kind of contextualize the message on the way down, and then also you can measure. So like you can see exactly who is kind of passed that message on and how many people have acknowledged it. So for that kind of retail sales leader at the corporate office, he can now say, oh, wow, in 2 hours, we're at 98% have accepted in Illinois, but we're only at 73% in Indiana. Oh, I've noticed that the guy in Evanston, he hasn't passed this on his message. What's going on? You can reach out to that guy and say, what's going on? It's been a couple of hours. How come you haven't acknowledged this message? And then that may kind of seem extreme, but I think on the cycles that retailers are working on now, a couple of hours could be very meaningful if that means that a promotion that's being paid for by a vendor starts now, and you've got 3 hours where you haven't been utilizing it, and it may only go for 3 days. Those are very valuable hours to the retailer. And then I think also there's all kinds of other stuff. I mentioned Rodeo Bot before, our AI tool that allows the retail and sales employee to kind of interact with a natural language chatbot that has a lot of answers. It's connected to all the various systems and all the other chat that's going on. So instead of going to a knowledge base and looking up a return policy for a specific product, you can ask RodeoBot, hey, what's the return policy for Apple Watch? And it'll just tell you in English, oh, well, it's 14 days or whatever it is. Or you can tell Rodeo, because it's connected to the various kind of HR and time and attendance systems as well. You can say, RodeoBot, I want to trade my shift on Friday, and it can present you 2 or 3 people who are working in your store who aren't working on the shift that you're working and aren't over 40 hours. And then it can say, you want me to reach out to those people and connect you to them? So it can kind of facilitate a lot of this administration, which is really important. I think one of the things that we see as an important to this kind of optimized retail future is, retailers removing the administration so that they can focus all of their kind of salespeople on connecting better with the customer and knowing more about the products. That's going to be a super important focus for all people. And we really think Rodeo is helping them do that.
And also maybe clearing up some time for the store managers, too, to focus on optimization there as well. Well, again, our guest today, Stephen Wakeling, he's the founder and CEO of Phobio. Today, we're talking a little bit about the Rodeo platform that allows for this integrated communication, this structured communication within a workforce in retail. Now, one thing I want to hit on is we've talked a little bit about, pushing out and disseminating information. We've talked about the chatbot, that type of thing. But when you work with businesses that adopt this platform, what's your communication to them about maybe going above and beyond just pushing out news or messages where it's kind of one-sided communication to make sure that people working on the lower level in terms of retail at these particular stores are using the platform and finding fulfillment. They just don't see it as a one-way communication tool, oftentimes like email is used now.
Yeah, and I think that's the thing. A lot of companies are kind of turning away from email as a kind of enterprise communication tool for intra companies, for communication that happens kind of within a company, to these tools, WhatsApp and GroupMe and Slack and all these other kind of chat-based tools. But I think you're exactly right. It's not just about the tool, it's about the kind of philosophy of the communication and best practices around communicating. And I think one of the interesting things, that Phobio can do is we're kind of sitting in the middle of this. We work together with brands, but we also present products for retail sales staff to use. We're incentivized to make sure that they understand how to use them and why to use them. And so we do a lot of kind of communication on our own behalf. And that's kind of what led us to the Rodeo product. I think we see ourselves as kind of more of a holistic solution provider, not just kind of the maker of an app that you can download and use yourself. So when we launch a new retailer, we kind of embed ourselves within them, understand like the structure of the organization so that we can kind of better set them up on Rodeo to make sure that it's kind of intelligently placing people in the right place so that we can have this contextualization of bulletins as they roll down the organization, but also present just like clear and easy to understand best practices around communication. I think sometimes, I'm knocking on 40. It would not be unusual for me to start an email, team, comma, I'm glad that you're reading this email today, and then have 5 paragraphs about the thing. And I think, if I'm 21, I see team, comma in the subject or in the little preview, and I just delete without. And we found that actually among most of our retailers who have signed up for Rodeo, they go from like a 12% open rate on these kind of big emails where everybody needs to get on the same page about something, which is staggering. And I think like it's very difficult to measure these things. We can only do it by survey pre-Rodeo, and post-Rodeo. Bulletins have like an 89% receive and respond rate. So you can see that your organization has seen this email, but also these Rodeo bulletins are a little bit like tweets. They're very limited in terms of their size and what information can be included in there. There's links to other kind of data or document management platforms, but that meat of that message, and we can do a lot of training with our managers and the kind of corporate sales leaders to help them understand that if you start out on email with 5 paragraphs, very few people are going to get to that 5th paragraph. And so how to communicate in a way where you're just boiling the bullet points up and just like presenting them, promo starts today, $500 for this device or something, you're much more likely to be able to get that message across. So it's kind of two things. It's not only is it the software and the tool, but it's also the kind of how you communicate and kind of bridging this, I hesitate to call it a generational gap, but there's certainly a communication gap between these two different generations.
We've talked about promoting things like promotions, for example, through this tool, but there are also other aspects of it too. And I think transparency is one thing that a lot of, especially lower level or floor level retail employees complain about. They have goals, but they don't really know why the goals are set, or sometimes they don't even know which goals they're working towards at all. Why is it crucial for retailers? Again, you guys work a lot in the mobile space, but why is it crucial for retailers to maintain that transparency for employees that even they might have just been onboarded 2 weeks ago?
Yeah, well, I think that's timing of the onboarding too. Like your first day, you're learning, where the bathrooms are and how to open the register and these kind of things. And then, 2 weeks in, that's when the osmosis learning kind of starts in the old system. And I think, you can use tools like Rodeo to stagger communications and say, oh, you've been here for 2 weeks. It's time that we start talking about this new kind of more advanced thing that you should know about. So we find that transparency really drives alignment, right? I mean, this is kind of important for all retail organizations, but especially those that have this kind of millennial component in their kind of retail sales staff, is the more people kind of understand about what's going on, what the goals of the company are, the more decisions they can make on a daily basis to align themselves to it. So you don't have to have so many policies to align the organization. It just kind of, that alignment can kind of become part of the cultural expectation. And so we do a lot of kind of coaching with our retailers to kind of help them. It's one thing to kind of create transparency, but I think a lot of times, you can't present all the information to a resale salesperson. You're kind of moving backwards when it comes to this reduction of administration. But once we know where you sit in the organization, we can make a reasonable guess about what information is going to be most impactful to you and kind of deliver that through some of the reporting and BI integrations that Rodeo also offers. It's so important for these retail salespeople to understand what's going on so that they can be kind of much more flexible in this consultative way about how they can deliver in their own way where you're trying to go. I think in the old system, it was, here are the 5 things that you need to do, just do them and, we'll pay you. And I think now to be able to deliver that best possible experience, you really need to be able to provide the direction and help these retail salespeople get under their own steam or under their own path. And I think, you end up having a much stronger sales team, but also, they're creating a better experience for your customer, which is pretty important.
I want to touch on one final thing just to kind of look ahead into the future without giving away any technological secrets or advances that you're trying to keep from competition. But what's next for this platform and kind of the growth of communication in the workplace in general in retail?
Well, I think there's definitely kind of this revolution going on. And I think a lot of companies are really grappling with how to address this change in communication away from email and onto these various platforms like Rodeo and GroupMe and Slack on how best to use them. And I think, a really big part of that, and I've mentioned it a couple times, is AI and using kind of very simple machine learning to kind of remove this administration, to focus, I hesitate to say human employees, but to kind of focus the people on the things that only they can do, which is kind of provide that connection and that relationship with the customer and continually enhance and improve the customer experience. And I think almost all of the tools that are kind of coming out today and are being refined are driving toward that horizon of creating a better experience in the kind of brick and mortar retail space and removing administration and empowering that sales force.
All right, Stephen Wakeling, the founder and CEO of Phobio, which of course has that platform Rodeo that we've talked so much about today. Thank you so much for joining us on the Retail Podcast.
Thank you very much. I really enjoyed it.
Well, we're back with what we could probably consider the food and beverage portion, or at least the food focus portion for the rest of this podcast as we look at the spirits retail, or really beer segment, as 2 brewing companies released their earnings on Wednesday. AB InBev and the Craft Brewing Alliance both released earnings Wednesday and gave us a snapshot at not only how this category is selling, but also insights on shelf space in retail stores. First, we mentioned that other than both selling the same product, there's not a ton of similarities between AB InBev and Craft Brewing Alliance, other than their partnership, which we'll talk about here in a bit. AB InBev markets themselves as the largest brewer in the world, and their portfolio includes Budweiser, Bud Light, also Corona, Beck's, Michelob Modelo, and Stella Artois. They have a market cap of $185 billion on the New York Stock Exchange. Craft Brewing Alliance, meanwhile, is a large consortium of original craft brewers such as Kona, Widmer, and Red Hook. They have a market cap of just under $353 million. The company's respective stocks are also going in different directions when you look at a macro level, with AB InBev hitting a new low since September of 2013 this week, and Craft Brewing Alliance at the upper end of their 3-year range, although down from the 52-week highs where they're trading at currently. AB InBev's first quarter, we see that on the revenue front, things were good for the brewer, up 4.7% year over year. However, volumes declined 0.2%. Own beer volumes did see an increase slightly of 0.5%. This increase in revenue with a decrease in volume means one thing: an increase in prices. In this case, the increases in prices were brought about by increased sales in their premium brand segment, which of course means that this impacted margins. The margin impact was borne out with a 1.3% increase in the cost of sales. However, EBITDA margins did grow 70 basis points to 38.2%. For this, they credited increased synergies borne out through recent acquisitions. In particular, SAB, which was credited with a $160 million cost savings in the quarter. Bottom line profit did fall from $1.458 million to $1.443 million, almost entirely as an impact of income tax increasing in the United States over a year prior.
Now let's take a look at Craft Beer Alliance's first quarter. They too saw sales growth. For them, it was 7%. The ever-important depletion number for breweries was positive for their Kona brand only. Depletions growing by 3% for that brand, but other depletions were down, and overall depletions down 4% across Craft Beer Alliance's brews. Lots of other stuff going on with CBA, which we'll get to here in a bit, but we do want to mention their bottom line number improved over last year, with diluted earnings per share hitting at 1 cent for the quarter versus negative 10 cents last year. So let's talk about that stuff going on beneath the surface. For CBA, they closed their Woodinville, Washington brewing facility last year. They actually sold it in the first quarter of this year, which helped out their SG&A costs. This they hold, along with exiting Memphis as one of their brewing facilities, will help to streamline their operations. They plan on moving forward with 4 breweries in the U.S., each mainland brewery brewing multiple brands. Their brewery in Hawaii will continue to brew just Kona. They opened a brew lab in Seattle late last year designed to spur development of new offerings under the Red Hook banner. Their partnership with Anheuser-Busch is a key tenet of their future. They spent a lot of time talking on this on the call, as well as their investor presentation, which they released this month. And that's why we lumped the two together here. They want to transition up to 300,000 barrels of brew work per year to Anheuser-Busch breweries. That accounts for about 600,000 standard kegs. They signed a 10-year extension to AB's existing master distributor agreement. They mentioned they feel like this will ensure shelf space in retailers going forward rather than having to go it alone. Additionally, this will improve their visibility overseas with an agreement to increase international distribution to $20 million in 2019 from $5 million in 2017. This agreement also established a $22 per share qualifying offer from AB in year one, which automatically snapped the one-year target estimate on the stock from analysts to $22 a share. Exactly that point. So you would have to think that if the share price were to get near there, Anheuser-Busch would go ahead and jump. And this is a fairly low premium from their current share price of $18.35, which has even gone down since their earnings release earlier this week. Now, both companies mentioned the increase in craft beer preferences among consumers, and this is why we bring it into this podcast, because it brings about an adjustment of shelf space. This is nothing new, of course, but the effect has been particularly noticeable of late. There's an estimated 11% compound annual growth rate for craft beers over the last 5 years, and growth is still positive for craft. However, the growth numbers are declining year over year. Still, amount sold is going up. Meanwhile, in the U.S. for Anheuser-Busch InBev, things weren't so hot. Sales to retailers went down 3.3% in the first quarter for Anheuser-Busch versus an industry average of 2.3% declines. So what's fairly interesting is that their lines are actually going down at a faster rate than the rest of the beer industry. Now, sales across the board being down, that was blamed on colder than average weather, but again, it remains to be seen whether this will be a longer-term trend or if we get a hot summer that sales go ahead and peak again. Budweiser and Bud Light, the two keystone brands in the U.S. for Anheuser-Busch, both declined in retail market share. For Budweiser, they declined by 35 basis points. They actually said they saw some positives for the Budweiser brand in terms of penetration, but Bud Light declined by 70 basis points in terms of retail market share. And they suggested that there might be an issue for Bud Light, which is that people look to Bud Light for advertising. Think about that Dilly Dilly campaign that's been so successful over the last 6 months, just about played out by this point. But again, able to use that signage in grocery stores. They command a lot of shelf presence in retail stores, and yet people are drinking the beer less and less and going to other beers on the shelf. And I think this is interesting and could portend a potential change in how shelf space is meted out at grocery stores, because again, we're seeing this not only for Bud and Bud Light, but we're seeing it for a lot of other bigger brands as well. This is something I would watch, though, at least from the retail perspective. The new brand released by AB in the first quarter, Michelob Ultra Pure Gold, is actually an organic line, or brewed with organic grain line, has lower calories, lower carbohydrates than Michelob Ultra. And Michelob Ultra is actually a brand that's done fairly well in terms of market share. So this is a hope for Anheuser-Busch, maybe not their only hope, but maybe a hope that they can get some of that macro shelf space back for their Michelob brand as they continue to concentrate on brands like Michelob Ultra and this Michelob Ultra Pure Gold extension to try and grab more of that shelf space. And I think you're going to continue to see some fruit beer lines being rolled out. Bud Light Orange, of course, has hit retailers here recently, and they're looking to those type of things to try and spur growth, as well as their spiked seltzer brand. However, the bottom line is the macro brews continue to lose out to shelf space to the craft brews, and even craft brews like what you see represented by the Craft Brewing Alliance still aren't flying off shelves. People are looking more and more to micro and nano brews, and grocery stores are now having to keep up with that, and that means distributors having to keep up with that as well.
Well, one of us drinks alcohol and the other doesn't. I'm not the one who does. Trent, between these two brands, is there a particular brand that's come out that you've been drinking lately that has really caught your eye and you think deserves more shelf space?
Nothing.
All right, then. Well, pizza and beer do go together in practice, so why not have them together on the podcast? Papa John's made our week a little bit easier in terms of finding stories that are relevant to our listeners, as net income fell over 41% and quarterly revenues dropped another 5%. We see that this was for their first fiscal quarter, 2018. This was officially the second earnings call also since the departure of John Snyder, who was the company's founder, who found himself in hot water over his comments regarding his perceived mishandling of the NFL protest this last year. Steve Ritchie, their new CEO, started at Papa John's in 1996, making around $6 an hour as a customer service representative. He became a franchisee in 2006, and in 2010 quickly was promoted through the ranks in corporate before he was named COO in 2014. He then went on to be president, and he's actually been long in line to take over the CEO position. And then this came about, and here he is, really at the helm of a company that is massive in the QSR pizza space. He has been praised for his leadership abilities and recognizing their most important asset, their human capital. He's big on giving everybody credit where credit is due. And as we look at the results of this company, this has to be taken into consideration. They've had a lot of executive changes. Some other changes we'll get into, not just at the very top, but also the other executives surrounding the CEO position. We go into the results of the company as the company had less shares outstanding than a year ago, so their earnings per share actually fell by a little bit less than their absolute net income drop-off of around 41%. Papa John's brought in 50 cents per share, also coming in 12 cents short of analyst consensus estimates. For reference, they have around 10.2% less shares outstanding thanks to buying back 1.6 million shares of stock versus last year. Because of lower net income and higher capital expenditures, the company had slightly less free cash flow as well. Revenues had also missed consensus estimates, but by a lesser margin than those net income misses. Corporate revenues are made up of several items within Papa John's. Despite selling off company-owned locations here recently, Papa John's still owns a significant portion of North American locations, 679 to be exact, or close to around 19% of the overall store count here in North America. They collect a royalty from their franchise stores and count nearly all of their international store sales, as they're mostly wholly owned as well. So that all said, the revenues were $427 million for the first quarter, $10.6 million off of the Wall Street numbers. Same-store sales for system-wide North American locations, including both their company-owned locations that I just talked about and franchise locations, decreased 5.3%. This is the exact opposite of what we had been seeing 2 to 3 years ago. We were seeing increases of 4 to 5%. Now we're seeing a significant drop-off in terms of same-store sales volume across all North American locations. Meanwhile, international same-store sales were up 0.3%. This is a segment that has long beat North American domestic sales, but for the first quarter of last year, all same-store sales were positive. So this really is a bad sign for the company, with North American same-store sales last year up 2 to 3%.
It was just last week that we discussed Yum Brands and Pizza Hut, and I mentioned that Papa John's had made a play into a lot of Pizza Hut's market share, but again, this earnings report brings to light a really, really tough time now for Papa John's, where they're giving a lot of that market share back, not only to Pizza Hut, but to an operator like Domino's, which continues to see robust same-store sales increases. And while some looked at this quarter and blamed what they say is a softer U.S. restaurant industry, Papa John's woes, we think, has more to do with their own business model and less to do with competition. The market overall, according to some research, is growing at about 2.5% per year in total sales. Those players that have made convenience and pricing a focal point has won out. Quality of ingredients has been another facet, one that Papa John's has certainly not ignored. In fact, all their ingredients are now preservative-free and all natural. They also have a gluten-free crust available, as does Domino's. But the problem here is, I would make an argument, and I think researchers do as well based on the research that I've read, that convenience and pricing are a bigger deal to customers now, and that Papa John's is in this weird middle ground where they're not a premium price pizza. They're not a pizza like you would see at Mod or Blaze, for example. So they don't have that level of premium ingredients. They simply just have traditional ingredients that are preservative free and all natural, yet still command a higher price point than Domino's, Pizza Hut, or Little Caesars does, and this results in them kind of getting squeezed out. We talk about a barbell menu a lot when we talk about the fast food or QSR or even fast casual industry, and this is a place where Papa John's is in the middle of that barbell, and they are getting squeezed out now. Papa John's has actually been doing better than Pizza Hut, again, up until the recent past, but they've kind of been filtered into this spot where Pizza Hut now more of a value proposition, and they've got more differentiated offerings, almost like the Taco Bell of the pizza industry. And if you look at what is to blame for the short-term misses for Papa John's, public comments about the NFL could have played a role. Maybe to blame were the NFL ratings as well, especially with Papa John's serving as the official pizza of the NFL up through last year. But we do know that NFL social media impressions were at an all-time high last year. Twitter highlight videos and banter actually do showcase some conventional commercials right before those highlights play. So it's a way to get those interstitials into play. So Papa John's, while they can blame all of these other things, they still got a lot of viewership on social media. And because of these issues swirling around Papa John's, whether it's because they're getting squeezed out price-wise or whatever it may be, the spotlight has rightfully been on Steve Ritchie to see if his leadership acumen can steer the Papa John's ship in the right direction. Leighton, I know you were on the call. Ritchie seemed very enthusiastic to you and very positive to you. What were some other things you took away from that call and from your impression of Steve Ritchie?
You definitely hit it on the head, Trent, in that I feel personally like he does care about this company. Again, this is a company he's been with for over 22 years in various capacities, starting at the very ground floor, becoming a franchisee, becoming a manager in nearly every part of the business. So he feels like this is a part of his life. And by the way, just by the by here, he's in his mid-40s, so he's not that old. He has a long way to go with this company. I think that is how his approach is set, at least for the midterm. He's looking at a lot of opportunity for Papa John's, and he's excited just to be a part of the brand. He cares about Papa John's success. He has taken personal ownership of the brand and feels like they can do better on multiple fronts in the short term and the midterm. Like I said, he spoke of recently hitting the 100-day mark as CEO. During this time, he has made it a point to meet with all stakeholders, including employees, shareholders, and franchisees that are closely tied into their business model. This open dialogue enables what we would consider a comprehensive approach, and what he quoted as a comprehensive approach to improve the business. To us, this sounds like much bigger changes are going to be coming down the line. As we know from looking around several like companies attempting to restructure, it does take time. You're looking at a company that is not really in dire straits. It's still very profitable. It still has a great brand presence, but it not only takes time to implement new ideas and best practices, as they are going to always evolve and change things for the better, but bear the fruits of that change. So even then, you could say that it takes months to implement a change, but it takes even months after to recognize whether or not it works and to get the rewards from that said change. Ritchie seems to know what matters, the very things we touched on with Papa John's in the recent earnings calls he touched on here. We've talked about their competitors succeeding in a number of ways, particularly convenience. And he mentioned 5 pillars that are going to make them stronger for the future. Making the brand stronger was one point, getting pizza to customers with less friction, and not having it be more of a customer chore was another. Currently, 60% of their sales, he said, are through digital means. They feel like this number can even go higher, and to be honest, Trent, I was surprised to see that 60% figure. I think they are headed in the right direction as far as how people are putting in their orders. Hiring the right people as well. He mentioned talent, talent, talent. He said, and retaining them is also a priority. So for management, this means a little different bonus structure. If you read those earnings call transcript lines, you can see that he's talking about longer term incentives for the company, not short term based. Really wanting to be employee focused, but also brand focused. Understanding that the employee isn't just a worker, but someone who's going to be potentially with Papa John's for the long haul and really wants them to be a part of that long-term success. Understanding that they are the ones closest to the end customer. And like I had mentioned, not just having a new CEO does Papa John's have a new leadership team almost entirely with a new CFO coming aboard and Joseph Smith. He has a great background in finance and he really is looking to take the company in a new direction. He only had a few brief remarks about the company's quarter, but I am curious to see how he performs longer term. They are in the midst of a search for a new chief marketing officer as well, and this is sort of a transitionary period for them. As I pointed out, they're trying to market in a number of different ways, and Trent had mentioned that really trying to reach the millennial audience and trying to gain back market share that some of their competitors have taken over recent months is going to be a priority for them. They want an overarching theme of differentiated messaging, which is going to be talking about quality and speed of delivery, connecting in order to communicate. And they make a good point here. Social media shouldn't just act as a soundboard for people to complain like we see on Chipotle's Twitter feed, but rather a place where they can look to improve customer loyalty at the grassroots level. So not only acknowledging the customer complaint that comes in via Twitter or Instagram, but actually understanding what was the root cause of this. How can we make sure this legitimately never happens again? And I think this is something that the company has touched on that a lot of other companies could actually use to their benefit. And based on company research, they think that they should target more of a value offering, something that is sort of a theme in this podcast. We talked about Fossil really saying that maybe value is the place to go, even though they have mid to high priced items. They'll test different ideas here with Papa John's in certain markets, certain new brand offerings that are going to be a little bit better for the family that is trying to extract value. They don't want customers to feel hamstrung. If, let's say, a family is tight on discretionary funds, but they still want to eat at Papa John's, he thinks, the CEO does, that they should still be able to make that purchase. We would agree that this would certainly improve transaction volume and potential average ticket declines should be ignored here with the value approach if their main goal is to maintain or improve total QSR pizza market share. With value pricing options, potentially paying more in bonuses to employees to retain them and to actually get them aboard, plus the capital improvements to their stores, we have to ask a fundamental question. How can they sustain a healthy bottom line with all of these initiatives? Well, luckily for longtime shareholders, profitability was talked about at length on the conference call. I'll condense it for you though. They are looking at ingredients to cut down on costs, something they've been looking at for quite some time, despite taking preservatives off the menu. They're also looking at new technologies for back-end operations to make things a little more efficient, which ties into the customer loyalty aspect and that people want their pizzas a little bit quicker. Ingredient sourcing alone has already netted the company supposedly tens of millions in savings, according to company spokespeople. They ought to be careful to not dramatically change the taste or quality of their pizza, though, as Trent and I were looking at a recent survey by PMQ, the largest pizza industry magazine, in which they cited a Consumer Reports survey that said basically nothing else matters except for the taste and quality of the food. And to put this in perspective, they put taste ahead of convenience. So for the pizza industry, this is a very important aspect to look at. Papa John's did speak of more efficient marketing to drive down costs as well. So for those wondering how they are going to be having more blanket advertising and saving money on their advertising budget, they said they want to promote more through the digital landscape, but they feel like they can actually leverage their allotted funds a little bit better. There are ways out there to squeeze out a little bit more impressions. And like we've been talking about, social media influencers, if they can get a big name out there in front of the Papa John's brand, it can do good for sales for the long term. And Papa John's kept full year guidance intact Despite all of these mixed messages, shares fell over 5% on Wednesday to $55 a share. They have since rebounded a bit to around $56.70 a share, north of $82 a share this time last year. So they are off for the 1 week trailing levels. Current market cap of $1.9 billion. Domino's has a current market cap of $10.6 billion. And if you want to compare apples to oranges here, just look operationally at how much faith shareholders have in Domino's. As Papa John's has 5,200 locations globally, Domino's has just over 15,000 locations, yet their market cap is 5 times as high.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
Well, we've reached the final stage of the Retail Focus podcast, where each Leighton and I take a look ahead at a story we're keeping an eye on for the next week, month, or year, and we begin with Leighton.
My looking ahead has to do with Costco, one of my personal favorite retailers, as I just got done shopping there yesterday. Costco, in a release, said that April sales were up in terms of e-commerce revenue as they rose 43% over last year. And to put this in perspective, revenue for the e-commerce side of Costco has been growing double digits over the last year or two, but it's been criticized widely because you see a lot of earnings figures from Walmart and Target talking about double-digit increases consistently coming in. But this is over a March level where they saw comparable e-commerce sales coming in at 34%. So I'm curious to see exactly what initiatives Costco has been putting forth. I'll tell you, again, for full disclosure, I am a Costco member, and I've actually bought some things on Costco's website. Once on Costco.com and then once using Google Express. They've actually partnered with a number of third-party sites to market their items. I think this is a win-win for the company because overall you get a little bit more traction. The more people that look at your items on Google, the more your brand's going to get out there. And to be honest with you, you're then able to leverage the discounts you may be able to receive on Google Express and get some wholesale items that you would normally buy at Costco for actually 10 to 15% less, which is exactly what I did. I used a promo code on Google Express, so I'm happy to say that I was probably part of those sales increases for April and in March. So overall, this is a company that we've been looking at for quite some time, not only because they're predominantly brick and mortar, but because they have been slow to adopt e-commerce. So I am curious of their next earnings call and what it has in store. And along with the earnings vein, I could see a lot of things happening next week in terms of Home Depot reporting and Walmart reporting. So a lot of news we're going to be covering next week on the Retail Focus.
Well, the story I'm looking ahead to is actually a story of tumult inside GameStop. GameStop, by the way, whose shares are down nearly 50% since May of last year. They got jarring news this week when their CEO, Michael Mahler, stepped down after just 3 months on the job. This after Mahler took the job and promptly cleaned house at the company. He ended up firing a number of people within the organization, and now he's stepping aside due to what is quoted as saying personal reasons. Now, sometimes someone steps aside for personal reasons, takes a job elsewhere, maybe a better job, or what he would see as a better job elsewhere. We don't know that that's the case yet, but what we do know is Daniel DeMatteo, who is GameStop's co-founder, also 70 years of age, is stepping now into the CEO spot. This is almost reminiscent of what Les Wexner did at L Brands back when a similar thing happened, only Les Wexner kind of worked his way back into the position out of his own volition. So this is a very unusual circumstance, especially after Mahler once again came in, fired their COO and an executive vice president. Meanwhile, others, in fact, leaving. All of this coming after the death of longtime CEO Paul Raines, who took a medical leave back in November and died this March. So GameStop right now in all kinds of tumult in the C-suite, some of it from their own doing and some of it from the doing of external forces, obviously, is I think they very much like the way Paul Raines was guiding the company last year. But again, the stock down 50%. The big question here, how do they rebound, and can they even rebound in this world of mobile games and direct-to-consumer sale of games by game manufacturers? So that's what I'm looking at. Not so much their next earnings call, but I think we're going to see the impacts from this shakeup over the next year to 2 years. Well, that'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent, saying so long until next time. Once again, we'd like to thank our interview guest, Stephen Wakeling of Phobio, for discussing new retail communication patterns and kind of the next generation of retail communication patterns. When we come back next week, scheduled to have an interview about Mother's Day. Very fitting, since Mother's Day was, of course, this weekend. Have a great week, everyone.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.